Hello everyone, welcome back to another video on personal finance. In 2010, I bought a house for 45 lakh rupees and in 2018, I sold it for 65 lakh rupees. It's not uncommon to hear such statements that someone made a profit of 20 lakhs in 8 years in real estate. However, what is the actual yearly return of investment? To know that, let's have a look at this statement analytically. I welcome you to real estate as an investment, what they should be teaching you in schools. First, let's look at the absolute return. That is a profit of 20 lakh for an investment of 45 lakhs. This is 45% return. But we know that this 45% is over a period of 8 years and not the yearly return. The yearly growth rate is called the cumulative annual growth rate or the CAGR. It can be calculated using the formula XIRR in Excel. To use this function, enter the expenses as negative and the income as positive, and the XIRR is entered in this format. We apply the XIRR formula to our case with expenses as negative and income as positive, and we see that the CAGR is 4.7%. Now, since the sale of property happened 5 years after the purchase, you need to pay tax on long-term capital gains. Had it happened within 5 years, you need to pay tax on short-term capital gains, which is nothing but the profit you made added to your income, and you pay according to your tax slabs. Long-term capital gains are calculated based on the indexation rates published by the government. They are nothing but the indication of the inflation in the country. These are the actual indexation rates published by the government. With this, we calculate the cost inflation index, which is the ratio of indexation rates of 2018 to 2010. Then we calculate the indexed rate of the purchase, that is, the indexed rate of 45 lakh purchase in 2018, which is 75 lakhs. Now, the long-term capital gain is the selling price minus the index price. In our case, since the indexed price is more than the selling price, our long-term capital gain is 0. So you don't have to pay any tax, else you would have to pay 20% of that long-term capital gain. So not paying tax is actually not a good thing in this case. This means that the property value has not beaten the actual official figures of inflation. Now, you might have rented out the property, or by living in the house, you are saving rent which you would have given elsewhere. Imagine you are getting a rent of 15,000 in 2010 and it increased 5% every year. With this additional information, the XIRR becomes 9.6%. Not everyone buys a house with full cash. Often a loan is taken. Of the 45 lakhs for the house, imagine you took 80% of loan, that is 36 lakhs. And for that, you have to pay an approximate EMI of 36,000. And in 2018, you have an outstanding loan amount of 27 lakhs. You pay that back with the proceedings of your sale. Also, imagine the best case scenario that you are also getting a tax saving of 60,000 rupees every year for the interest paid. With these information, you see that the XIRR is now minus 6%. That is, the value of investment has actually depreciated, even though you got 20 lakhs extra apparently. Finally, if you are renting out your house and the tenants change every year, and you need to pay a broker to find a new tenant, and you need to pay the municipal taxes too, both together amounts to say 20,000 per year. With these additional expenses taken into account, the investment appreciation is actually minus 6.5%, and you end up with a cash of 36 lakhs in 2018. Like this, you can add all the expenses and income you had for that investment and calculate the final XIRR. When you bought your house, you had 9 lakhs in cash which you spent for down payment, and you spent 4.3 lakhs every year on the EMI. If you had put that money in fixed deposit instead of buying a house and got a 6% return, you would now have 59 lakhs. In PPF, with an 8% return, you would have had 66 lakhs. And in, say, a mutual fund with 12% return, you would have had 81 lakhs. In these scenarios, you did not actually buy a house. You will have to pay rent and will not have the tax savings you had for the interest of the home loan. So considering all that, other investment avenues yield 31, 35 and 44 lakhs respectively. How did you end up with higher money in real estate than FD even when the real estate growth was negative? This is because you had a capital of 45 lakhs invested in 2010. You got a loan. But for FD, you have only 9 lakhs of your down payment and 4 lakhs EMIs, 13 lakh in the first year and 4 lakhs in the subsequent years. Comparing real estate with other avenues. When you buy a house, it's not easy to find for which the value will appreciate the way you desire. Whereas mutual funds and fixed deposits are literally armchair investment. You can sit at your desk and do all the research you want. The minimum amount for real estate is very high, but for a mutual fund, it's as low as 500 rupees per month. Even with the real estate regulatory authority around, there are still a lot of unregulated transactions happening in real estate. Whereas almost everything in the share market and banks are regulated by RBI and SEBI. Also, as we saw before, you will get a loan for investing in real estate at comparatively low interest rate of 9%, but you will not get a loan for investing in FD and mutual funds. So you have a good head start in real estate. To conclude, what I'm saying is not to buy a house. What I'm saying is when you think of buying a house as an investment, consider all these points, especially when you max out your salary for a home loan and do no other investment. Thanks for watching and to be continued.